Why trade futures? Here we're going to dig into 8 reasons why to trade futures. They have 24-hour-a-day access, nearly 6 days a week. You can act on them outside of non-US hours. So this is helpful for our Australian traders, UK, and anywhere around the globe that doesn't happen to be in the US. And it doesn't mean that you have to stay glued to your screen, okay? Don't equate constant availability and open access of a market to, well, I need to sit there and trade every opportunity. No. It's just knowing that depending on your work schedule, maybe you're a West Coast trader and you got to get up early to trade. Or maybe, like I said, you're out in Australia or somewhere where you want to trade in your afternoon, which is the middle of the night here in the States. This gives you that opportunity. Number 2, deep liquidity. This is one of the most important reasons, okay? The greater the liquidity, the greater the chance of the trade being completed. And that's important because you want that fast action. Number 3, leverage. You have the ability to control a large contract value with low capital. For example, the ES. This stands for the E-mini S&P 500 futures, which we'll talk about in a moment. This is the most liquid, most traded futures market on the planet. And it allows you to trade the S&P 500, which is the collection of the 500-ish largest stocks in the US, basically the largest stocks in the world. And you can do this with greater capital efficiency, okay? Now, you always want to use a greater risk management plan when you trade. Just because you have leverage and you can trade a larger portion and have more control with a smaller amount of money doesn't mean you should go crazy, right? There's things called margins you have to be careful of, meaning there's a certain amount of money required in your account to be able to trade one contract of any specific future. All that information is specific to an exchange. All right, number 4, ease of going short. This is something I hear about from our stocks traders that, either they're scared to go short because they don't think the trade will get filled or they'll have a lot of slippage. Taking a short position is just as easy as a long position on most heavily traded futures contracts. And day trading restrictions don't apply to those shorts the way they do to other markets. Now, again, always check with your specific brokerage, your account, and for the futures you are trading. All right, now we move on to number 5, efficiency. Because there's a tight bid-offer spread, this can lower costs associated with getting into and out of position. So again, reduces the slippage, there's less time delay, and generally futures have better commissions, which I may touch upon here again, but I really want to drive that home. Diversification. Futures can help you during times of market volatility. They can be traded directly as your main instrument, or they can be used as a hedge to protect against sector exposure. So if you are a stock trader or you are trading ETFs based on particular sectors, perhaps technology or a smaller ETF like microprocessors, right? In this day and age of AI, these are the stocks like NVIDIA that are leading the market. If there's any sort of uncertainty or volatility, you can use futures to help protect your positions. No management fees and tax advantages. Now, these I put as 7 and 8, not because they're not important, but because they get specific back to your particular exchange brokerage rules. So always do your due diligence and check with those resources.